Good morning, everyone. So today I thought we'd just go through, I guess, my views on capital raising. I thought just kind of outline the capital raising process, source of capital, and I'll actually spend probably most of the time this morning on deal structures and term sheets. I think that's probably after pitching, which hopefully most of you saw that, probably the next most complicated or potentially confusing part of capital raising, and then just a couple of other miscellaneous topics towards the end there. So starting right in on the capital raising process, there's a number of steps that you need to go through. First and foremost, you definitely should identify potential investors, and we'll get to this right at the end, but you really want to get a good match between what they want to invest in and what your product or offering is. And there's both technical matches as well as personality, but we can touch on that a little bit more later on. Obviously you need to arrange your meetings, there'll be follow-up meetings, due diligence. Due diligence, I think, both exploratory, which is where the investor tries to essentially understand the business as you pitch it to them, and often that, or hopefully, leads them to do a term sheet. And then there's the confirmatory, which is where they just verify essentially that everything you told them in exploratory is actually true, maybe reference checks, market background, stuff like that. All of this process can actually take a surprising amount of time, often much longer than people expect. So for angel investors who can typically move pretty quickly, that can be 1 to 2 months. But for VCs such as Starfish Ventures, it can take 3 to 6 months, which is a long, long time. And a lot of that is because, if we're investing millions of dollars, we really want to make sure that we know the team and that we understand the business. So before you head out on your capital raising adventure, certainly allow yourself enough time. And many companies struggle because, if they had a small amount of money or a seed round, or they were graduating out of MAP or something like that, and are surprised at how long it might take to actually get the right amount of funding to grow the business. So I think it's probably appropriate, I'm obviously in venture capital, but venture capital is absolutely not the only source of money, and in fact, in the scheme of things, if we look at, take a step back for a minute, there are many sources of capital. So starting with, public equity, where you have publicly listed companies or public unlisted companies. So listed companies, hopefully most people are familiar with on the Australian Stock Exchange or wherever around the world. First, many people view listing as an exit mechanism, which it often is. But first and foremost, it's actually a capital raising mechanism. It's an IPO, the initial public offering of your stock to the public markets, and essentially, that money goes into the company. However, obviously you need to usually be of a certain size, certainly have revenue, ideally be profitable, and then you're more suited to that publicly listed market. There is unlisted companies, somewhat rare. The number one reason why companies become public unlisted is where they have a number of shareholders, basically 50 or more than 50 non-employee shareholders. You actually have to become listed at that public. You're classified as a public company even though you're unlisted. And what the ASIC is really saying is once you have that many shareholders, then the rules and regulations governing your information disclosure and so on actually goes up. So one of the things that, as we work our way down into private equity, if you're doing angel rounds, you actually need to be a little bit careful that you don't have too many investors. Like, you really don't want to raise $1,000 from 50 people, accidentally become public, or be forced to become public, and then the reporting requirements are much more onerous. So it's just one thing to keep in the back of your minds, if you're looking at capital raising. So apart from public equity, there's private equity, and private equity actually comes in many different flavours. So obviously the financial institutions, and there's a number of different, financial institutions that invest at different stages, and I've listed a few there, with venture capital probably being the earliest stage investor amongst the financial institutions. But there are some other ones, as I've listed there, just to give you some idea that as companies go through all these stages, so venture capital is for new businesses. Mezzanine is often for like pre-listing, where company, it's the last round before a company may go public. Growth is where you have a reasonably established business, maybe with tens or hundreds of millions of dollars of revenue, but just wants to tap into maybe a new market or a new product. And leverage buyout, a whole different kind of class where essentially, one set of shareholders is being bought out by another. Often it's a publicly listed company that's then being taken private. But I imagine for most people here, of most interest is both venture capital and then the other source of private equity being angel investors. And often companies start their capital raising round, through angel investors or seed programs to get them on their way. So when you go to raise that capital, if you've identified where you want to get that capital from, be it angel investors or probably venture capital, we'll focus more on for, I think for MAP. There's really, three main types of structures that people are going to give you money on: debt, equity, and convertible notes. So let's just start in with debt. So there's a number of key terms, I guess, around when someone offers you debt. And essentially you can think of those as things like a mortgage on your house, right? Where the lender is going to give you the principal, which is the money, and really with debt that can be anything from really small amounts to hundreds of millions of dollars. And probably the next key term is the interest rate, which I'm sure most people are familiar with. We get a lot of coverage of that in the news. And then the repayment period, so how quickly do you need to give that money back. And for capital raising in companies, that time period is probably from 1 to 4 years, unlike, say, houses, which may be, your 30-year fixed-term loans. For companies, the expectation is that the capital will be repaid reasonably quickly. One key item about this repayment is also the terms around the repayment, whether it's interest only, so as perhaps each month or every quarter, you need to make an interest payment only on that principal, but the actual principal remains the same until the end of the facility, or whether you actually pay it down over time. Or there's actually a third way, which is repayment is just like a total balloon payment at the end, which is everything, debt, the principal plus the interest, all in one hit. With debt, you've got to be, I guess, maybe careful is not quite the right word, but at least aware that the interest can really add up. And if you have a balloon payment, and essentially a balloon payment is any time where the final payment is much bigger than the monthly or the kind of recurring payments, that as to how you're going to service that debt right at the end. Because usually the lender will have collateral, which is the next item on that list of terms, where it says, okay, I give you this money, but if you don't pay the money back in a timely fashion, what's their claim over you or your business? And they may have claims on specific assets. There's certainly many sort of equipment lending firms, so that if you're perhaps starting a hardware business, you need like a chip manufacturing plant or a circuit board printing line or something like that, where there's very specific equipment that does that. You can actually get a loan specifically for that equipment, and the collateral is that piece of equipment, so that if the company goes bankrupt or you don't make your payments, then the lender obviously keeps all the money that you've given them and takes that piece of equipment, which they'll have carefully calculated that they'll be able to resell for more than you owed them, or at least, you know, in the majority of circumstances. They can have much broader forms of collateral, such as liens on the IP, which effectively means they own the business. And this is where those balloon payments or things like that can be tricky, because if you have an otherwise valuable business that's maybe, you know, it could be making millions of dollars in revenue, but it's not profitable yet. So you've got, you know, 20 staff and you basically break even and you owe maybe $500,000, but you don't have $500,000 in cash. And if that balloon payment comes, that's why I say you've got to be aware or careful, and they have a collateral which is essentially on the IP of your business, they've effectively just bought your business for $500,000 and there's nothing you can do about it. So you really, with debt, want to be sure about what, you know, the whole form of that, I guess, structure, that you're on top of it, that your business is going to be able to service that facility. And apart from those kind of four things, there's another two kind of items that may appear in debt. Covenants, and that's essentially where the business needs to make promises about essentially the state of the world for the debt. So essentially the lender says, I will lend you this money at this interest rate and you repay it and everything else, but you've given me these revenue projections and you need to covenant that you're going to meet them. And there's an or, and usually that says there's some penalty, is that if you don't meet that, then there will be penalty. Usually that will be in the form of either increased interest or penalty payments. And normally that's another, or not normally, or often that can be another way that debt spirals out of control, where you fail to meet some covenant, and again, you know, maybe it's revenue and you miss it by $1 and the interest rate goes up, or there's some penalty payment that you can't make, and then you're in, you know, this, and then they get to the collateral and you may have just lost your business over a few dollars now. So these terms, you definitely got to, you know, think it through carefully, because debt often seems pretty cheap because you don't have to give up any equity, but there can be a sting in the tail. So often debt is, well, I'd say in my experience, debt is much more common for larger, more established companies, because they have the revenue and the cash flow and much more certainty around it, that they can take on these commitments about the repayment schedules and have reasonable certainty that they're going to meet them. And so often that's why debt can be up to, you know, the hundreds of millions, because essentially it's a bank loan and they have the securities and assets to service it. A final term around debt is warrant coverage, and essentially where you may think, as if the lender is not getting enough with all these other things, this is a way for them to make even more money, which is where they essentially demand options over equity as a kicker, right? So there's no actual reason. They just say, look, even though you're going to pay us interest, and that's great, we kind of want an equity interest too, and so you'll issue warrants. And the way warrants work is that, or most often, is they come as a fraction of the amount they lend you. So let's say you want to borrow $1 million and maybe there's 25% warrant coverage. So that means you need to issue $250,000 worth of warrants. And essentially what that says is that you value the business and they will get options, so $250,000 worth of options at market value. So if the business kind of grows, then those options come into the money and they make even more money. If it's flat or it goes down, then they're effectively worthless, but they still make money on the interest. So again, that's kind of another term where maybe debt sounds good because you don't have to give up equity, but if they add in warrant coverage, then there is some portion that you are. So on to perhaps, well, it's hard to say what's the most common, but equity, which is perhaps a more well-known form of investment, and certainly what we as venture capitalists would favour, and also angel investors would most normally do equity. And there's a bunch of terms around equity. So there's 2 slides of this just to set you up. So there's financial stuff, and then there's kind of the other, which we'll get into. So the investment amount can be anything. Again, I've just listed some of the lower end of the spectrum there, where typically for up to $1 million, we'd call that like an angel or a seed round. From 1 to 10 might be Series A, 10 plus Series B, but there's really no limit. C, D, E, F, G. They keeps going, but roughly speaking, at the lower levels, that's kind of the names people give it. The price is all about the pre-money valuation, which we'll touch on in a couple of slides. And then equity comes in a variety of different forms. So the most basic form is ordinary shares, which is what you might expect, is just where someone owns kind of a fraction of the company, similar to the founders, where if the company's sold, then you just split up the proceeds on a pro rata basis. That's all pretty straightforward. Very few investors will invest with ordinary shares. What most investors use is preference shares. And all preference means is really they have preferential terms over ordinary shares. What those preferential terms are forms kind of the rest of everything else. So the first thing they may have is a preference amount. And typically that says that if you have, like 1 times preference, that says if the company is sold, then the investor kind of gets the amount they invested back first before anyone else gets any money. So they essentially have first dibs on the proceeds. And that can be quite reasonable if the entrepreneur says, hey, why don't you give me this money, we're going to build all this big business, but if it doesn't work out, there's an argument to say it was the investor's money in the first place, maybe they should get first slice of the cake. But the actual preference amount, again, there's variation where they might say, well, it's not just I get my amount back first, actually this money comes from my investors, I need to make a return. So maybe that preference amount is 2 times or 3 times, where the first, if they invest $1 million, then maybe the first $2 million has to go back to the investor, or the first $3 million. It's quite rare that it goes above 3x, but it can be anything, it's just a number. And then the next thing is around preferential terms, is about participation. So participation is where, okay, so we've said they get their preference first, but now if you have non-participating shares, then that means that the investor essentially chooses where they either get their preferential return back or they convert into ordinary shares and just participate pro rata. So you can see where that would happen, where if you invest $1 million, you get 25% equity. If the company sells for anything above $4 million, then 25% of 4 is going to be greater than the preference amount, so they'd convert. However, if they have fully participating preference shares, then, and some people think of this as double dipping, where what happens is first they get their investment back, and then they participate alongside with every other dollar that comes in. So you get your investment back plus the pro rata participation. Obviously that's pretty good for investors, particularly in the lower stages. And so participation, that can be non or fully participating. I don't think there's rarely cases where it's anything other than the two. Then there's other terms such as dividends, whether they get them in preference to ordinary shareholders or not. Redemption, which says that if after a certain period of time there hasn't been an exit, can the investor make demands to get their money back? And that is again a clause to look out for, and falls a bit like what we talked about with the debt, where if you haven't exited in let's say 5 years, one reason may be because things haven't gone as well as planned, and you may not have any spare cash in the company. And if an investor then redeems their shares, essentially that will put the company into liquidation, and because they then have their preference, they'll own all the assets. So these are all just terms that are to be aware of. And to be fair, it's not like good or bad. It's more, at the end of the day, the company needs the money. And so it's really about balancing, your level of confidence, what you can do, with what you're willing to give up. Because the investor, they're the ones with the money, and they have a choice of investments. So even though many of these terms and whether say participation can cause a lot of angst in the entrepreneur, I wouldn't say it's good or bad. It's just things to be aware of, and I think hopefully after this lecture, things that you can think about to say what trade-offs do you want to make? Because everything's a trade-off, because certainly, and I've got a couple of charts later on, but with the pre-money valuation, which is often the #1 thing that an entrepreneur goes in and they care about. They go, oh look, I want a pre-money of 5, or I want a pre-money of $10 million, and this and that. The investor will often trade that. They'll go, all right, well, how about I'll give you a higher pre-money, but I want fully participating shares, or some 2x preference amount or something like that. And that may all be a win-win, because in the highly successful case, the entrepreneur will get a greater share of the outcome. But in the low outcomes, which is where the investor really cares about getting their money back, they get some protection around their investment. So that can be a really good trade-off. It's a way that the entrepreneur can negotiate a better pre-money by trading off against some of these other items. Conversion is probably the last of the financial terms we'll look at, and that's just where, when a preference share would convert into an ordinary share. So with non-participating preference shares, generally the holder of a preference share would want to be able to convert at any time, and they'll then choose to convert on exit when that exit value is above a certain amount. Generally, conversion's probably not really a controversial kind of item. Usually the holder of the preference share will want to hold it as long as possible. As an entrepreneur, you're happy for them to convert at any time. Usually the only thing around conversion is the entrepreneur will want, essentially there'll be a mandatory conversion on an IPO or maybe certain other exit events, because otherwise it's pretty difficult to list, it makes it more difficult to list the company if the company's not just straight ordinary shares, because of public buying in don't want to have this idea where they buy in with their money, but there's still some other equity holders that get preferential treatment over them. So quite common and not unreasonable for the entrepreneur would be to demand automatic conversion to ordinary shares at IPO. So I mentioned there were a number of other terms around just the financial side of things, and typically these are around control. And this is where essentially the investor wants to be able to look after their investment. So firstly, voting rights. That's most often on an as converted basis. So it's as if all the shares are of the same class. But it is possible, and certainly a bit more in favour now, large are companies where some classes of shares have different voting rights. So for example, Google, I don't know if you're aware of a small company, Larry and Sergey have a special class of share. So essentially, even though they own significant stakes, certainly in terms of dollar value, I think they own each about 10% of Google, maybe 5%, thereabouts. Between them, they can vote, I think, almost anything through, just because they have these preferential voting rights. So certainly, they don't need the ordinary shareholders to vote, that's for sure. Another key term is anti-dilution. And this is where, again, speaks to one of these protection mechanisms that investors want to essentially protect their investment on the downside. Let's say the entrepreneur comes in, they pitch that their company's worth $10 million. The investor says, look, I think it's only worth 5, you haggle. They go, I'll tell you what, I'll give you, 8 or something like that, but I want anti-dilution. And what that means is that if you raise capital at a lower value per share than that investor paid, they essentially get to reprice their shares. And there's 2 forms of anti-dilution. Most commonly is with like a full ratchet or full anti-dilution, or an average weighted one. Definitely as an entrepreneur, you want average weighted, and you should fight for that keenly. What the difference is that if I invest $1 million at $1 per share and I get my 1 million shares, with a full ratchet anti-dilution, if you then raise, you just need a small amount of money, $10,000, let's say, maybe to pay off that debt that they've called in or something like that, and you're having trouble raising it, and you want to sell those shares. So you say, look, I'll sell them at 50 cents a share. It's only $10,000. It's not going to make a huge difference to the cap table. With a full ratchet, that whole $1 million investment gets repriced at 50 cents per share. So in other words, you would then need to issue the previous investor, like essentially 1 million more shares, just because you raised a small number at that 50 cents per share. What an average weighted calculation does, and it's a super complicated calculation, but essentially what it says is you need to issue more shares to the investor, but it's more in proportion to how much you raised and the fraction of the price difference. So that if you raise that $50,000 more, which is about 1/20th of the original $1 million, and that's at half the price, then the amount of extra equity you need to issue, and I'm not going to go through the calculation, is more in line with, maybe you need to give them another 20,000 shares, not the full 1 million, because in relation to that $1 million, you haven't really raised that much more money. And that's a term where often term sheet will have full ratchet. You as an entrepreneur would really want to argue for average weighted, and that's a very fair ask on your side, because a full ratchet anti-dilution, again, if the company gets in trouble, spirals out of control very quickly. The next control piece is probably representation on the board. It's quite typical for an investor to have at least 1 seat or maybe 2 seats on the board, and that's so that they can obviously participate in voting on the direction of the company. For many investors, certainly for venture capital firms and certainly for Starfish, we would see board representation as a value add, and hopefully the entrepreneur would as well. So essentially, we're actively engaged in the company and want to help with the strategic direction, with hires, with marketing strategy, sales strategy, all that sort of stuff. So hopefully that's a bit of a win-win as well as a measure of control for the investor. Some of these things are really essential, because without them, like without control factors, there's actually no reason why, like if an investor didn't have these things and they gave you $1 million, like you could just go out and buy a company plane, right? And then just, or a yacht. And like generally there's nothing in the Constitution that would stop the CEO or anyone who has that power to vote in a new plan to do that. And definitely an investor wants to say, look, the money has got to be used for what we agreed, the plan of record. You know, when you went in and raised, you said you're going to hire all these staff, so we'll approve a plan of record that goes before the board approves it, and so within those bounds, the entrepreneur then has free rein to go run their business. But if they want to change the plan, then they need to come back to the board and get approval. And as I said, hopefully that's all in alignment. Just to, everyone should be on the same page there. There are certainly cases where that hasn't happened, but that's more about choosing your investors wisely. And one of these factors, well, when we come to that too, about there's more than just getting the money on favourable terms from investors. Along with this board representation is this idea of veto rights. So even if the investor is not on the board or outside of that, usually there's a list of reserved matters, is also what they're called, where you need shareholder approval, specifically that investor's approval before you can take certain actions. And those will generally be along the lines of or one of the most common is change of pay, particularly for the CEO, i.e. yourself. So you can't just say, oh, for that $1 million, hey, my salary is now $500,000 a year, fantastic. You'll need to get shareholder approval before you can do that. Also entering into any significant agreements. For example, doing any of the debt. So if you raise debt, you'd probably need shareholder approval. Again, things that may affect the investor's investment, where it may not be to plan, so that the investor can just protect their investment. Another key one would be the issuing of further equity, so that once you get the money, you can't then just go, hey, why don't I create a new option pool, issue myself a bazillion options, and now that investor, when they thought they were getting 25% of the company, now has 2%. That will be a reserved matter. Another control kind of term is around this preemptive rights, which is where if you go to raise more capital, that the investor has the right to participate. Commonly would be pro rata, and again, this is something you could argue for as an entrepreneur, but it may be up to even full preemption right, so that if you want to raise $1 million, that investor has the right to take it all under whatever terms you put forward. But essentially it says you can't go and raise money on better terms than you offer to your current investor. And one of the reasons for that is, again, if the company, most commonly if the company gets into trouble and there's a down round, in addition to the anti-dilution provisions, the investor may want to participate because they may still believe in the company even though things haven't gone to plan, and they want the opportunity to get that equity rather than some new investor essentially leveraging the past investment and then owning the majority of the company. Also another way, again, that's a control mechanism where so the founder can't just do a round of $50,000 to their friends and family and sell off 50% of the company and effectively dilute the investor again. But typically that would also be covered in the veto rights, so there's probably a couple of reasons why you couldn't go and do that. And then probably the final item is around this Cosale, Tagalong and Dragalong rights. So just to quickly touch on those, that's where the investor says, so with Cosale, it says that, hey, if anyone sells shares in the company, I have the right to sell alongside. So that if it's like, rats leaving a sinking ship, is that if the founder is thinking of selling out and leaving, they can't, kind of sell their shares and leave the company and leave the investor just, holding this empty shell. So that the investor would want the ability to sell alongside. And Tagalong is kind of pretty similar. So a few minor differences, probably not worth touching on. And Dragalong is also quite important, which says that if the majority of, or some number, usually a majority of some format, whether it's just 50% or 2/3 or 3/4 or 90% of investors decide to sell, then every shareholder has to sell. And generally that threshold will be chosen pretty carefully. Most commonly the investor would calculate it so that if they and the founder or a number of other key shareholders agree to sell the company, then everyone's forced to do it. Because the one thing you don't want to have is some sort of green mail situation, which is where some angel investor or some friend or family or something like that invested $1,000 in the company, and the company's gone on to raise millions, it's worth hundreds of millions, you're about to sell it for whatever, $1 billion, and they go, yeah, I'm not happy with that, you should give me more money. And given the stakes of money involved, like settling patent lawsuits, it's often better to pay them off than it is to have the fight or let the whole deal go south. So a drag-along is typically, you know, just more good business practice. But you do want to be conscious of what that threshold is, because as time goes on and the founders own less and less, and will definitely get down to a minority of a company as it becomes bigger and bigger, you just want to think it through where you as the founder don't want to be dragged along, where you still believe in the business, you're loving it, this offer comes in for a couple of $1 million, the investors are sick of it, they all vote to sell out, and you have to sell as well. So that's where you really want to pay attention to that threshold percentage. I was thinking, any questions? We kind of touched on a few things both through the debt and the equity. Rowan?
Can you just explain what a down round is?
Sorry, explain.
A down round?
So a down round is just where the price per share is less than the previous round. So, and it's not quite as simple as just the pre-money being lower. Probably a more closer thing is where the post-money is lower, but more accurately, because there may be options or things that have issued, it's just where essentially the value that the new round is at divided by the number of shares, the total number of outstanding shares, is price per share. If that price per share is less than what the investor paid. Yeah.
I had a question on pre-money valuation. How do you establish that figure?
Okay, we'll get to that. Great question. But before we do, let's have a look at just some of the differences between these participating and non-participating, just to see where the differences are. So these charts, essentially on the left and right, the left is a zoomed in version of this lower corner here, just to see what the difference is. So with this participation, which often causes is one of the more heated discussion topics between an entrepreneur and an investor, what difference does it really make? And what you can see here on the left is at low sales prices, at low exit values, it makes a significant difference between how much the investor gets, which is in orange, versus how much the entrepreneur gets. It really clearly shows you this preferential return that, you know, in this example, that, you know, at an exit value of, you know, what's that, $5 million, the entrepreneur's getting 1 and the investor's getting, you know, most of it, 4. And that's because that, you know, that's with the, and that's the fully participating preference share. But the thing to note though is that as the exit values, oh, we lost the title. As the exit values get bigger, that the actual shareholding, and I think in this case the investor has a 40% equity stake, that the amount of difference that participation makes is really quite small. So that, you know, without participation, or if they just had ordinary shares and 40% equity, at 100 million they'd get $40 million, and this is, you know, barely different. So that's why we say, or look at, you know, it's more protection for the investor in the low outcome scenario. And often entrepreneurs come in pitching where they go, you should give me a really high pre-money because this company is going to be worth hundreds of millions. And the investor can, I think quite rightly say, okay, if you believe that, let's do fully participating, I'll give you a higher pre-money Because if you believe it's worth hundreds of millions, you don't care about this, but I really do. And you know, in the case that you're pitching to me, where that value is justified, you'll get all the rewards. So here we see, you know, the effect of non-participation, and this is where at first the investor just gets their investment back before the entrepreneur gets any money, and then there's a point at which the investor would just convert, or they just get their preference return, and everything goes back to the entrepreneur, and then ultimately there's a point where it converts. But again, what you see is that, you know, in the large scale, it doesn't make a huge difference. It's just really around those low exit outcomes. So the third equity form, before we get on to the valuation topic, is convertible notes. And even though it's not unusual for the initial seed round to be convertible notes, so you may come across convertible notes first, I put it last out of the three here, just because it's a blend of the two above. So what a convertible note is, it kind of starts off as a loan where you have a principal with an interest rate and there's a maturity date. However, the convertible note, the reason why it's called convertible is it has the ability to convert into equity, which is the most common form of, I guess, discharging the convertible note. Rather than repaying it back, you just give them equity instead. But with that, convertible notes, again, kind of are tricky because they have all the terms and conditions that both of debt and that equity side of things has. So with the convertible note, you definitely want to, you know, pay attention to the terms of the loan, potentially the redemption, like when can they ask for that money to be repaid? Is there, you know, this maturity date? What happens then? But then also the terms around when does a convertible note convert into equity. And generally there's this concept of a qualifying financing, which says if you raise X million dollars, then the convertible notes will automatically convert. They will usually convert at a discount, and that's fair enough, because essentially someone's given you money ahead of time, and then presumably you've used that money to build value in your business, and you're now raising capital at a greater valuation than you would have, and yet these notes are just converting kind of at that later point in time. So it makes sense that they get a discount to that round, which is essentially their risk premium for, you know, investing in you earlier. And certainly that discount rate or that risk premium is going to be related to that maturity date. So, you know, if you have a 6-month convertible note, the discount would make sense and be fair that it's less than if you have a 12-month or a 2-year, you know, convertible note, because that's just giving you more time to build the value at the cost or at that the investor has actually paid for. And then there's questions around, well, what does a convertible note convert into? Typically, if you have a qualifying financing, it just converts into whatever equity is then. But often there's, with this redemption, there's maybe the ability for them to convert into equity, like just a pre-agreed form of equity at a pre-agreed pre-money. So that, because most often, if you haven't raised money with a convertible note within a certain period of time, if they're going to redeem it, the company is not going to have the money to repay it because they've spent the money. So, so the question is then, what do you do? As with debt, you could just bankrupt the company, or another mechanism is, no, why don't we just get equity, you know, some significant portion of equity, because the company obviously has underperformed, but then we can go and raise capital, you know, kind of on that new basis. And convertible notes may also have other kind of rights and privileges, such as information rights, board observer rights, things like that. Again, just so that the investor can manage their investment. Convertible notes can be, I think, sometimes quite tricky. Anybody have any quick questions on those? hopefully, yeah, if you think of them as this blend between debt and equity, well, it starts off as debt, but then can convert to equity, that's what it is. Yeah.
I have a question, not just on convertible notes, but all the different structures there. In terms of the terms, there's going to be some sort of negotiation process with the entrepreneur and the investor. But for a new entrepreneur, they don't necessarily know what's a normal structure or what's a good structure for them. You know, that obviously they're worried about getting the best deal that they can. How do they know what things can they do to sort of understand going in there, knowing what is a good deal for them and what isn't?
Yeah. Well, step one would be to go to a class like this, and you know, 'cause there's definitely things around, you know, like around the full ratchet versus average weighted, you know, which you'd say is a trap for young players, or you know what participation means, you know, when's it good, when's it bad. So I'd definitely say, you know, you can research it. I'd read up, like, and a lot of that stuff with the options, I've kind of gone through what typical values would be. So you know, if you got terms that said, oh, the interest rate is 20%, and you referred back to the slide and go, well, Tony said it was 6 to 10, that might be a bit of a flag that actually that's out of market. Or if they got a discount rate of, you know, 50%, you'd really want to, you go, well, oh, Tony said 20 to 30, why are you so high? Like, I think hopefully you're learning a bit here today, but also, you know, there's just a bunch of research. There'd be, you know, many articles online on, you can look up around each of these terms. I think the key thing is to be aware that they exist and what they kind of mean. I think hopefully most entrepreneurs can kind of think through, you know, what the trade-offs are. This shouldn't be the most complicated decision in their business, but it's more awareness that you know, what are each of these? Why would an investor do it? What are the implications? And therefore, you know, you can kind of make the trade-off. So yeah, I'd say that. Also, speaking to fellow entrepreneurs, particularly those that have raised capital, you know, tremendous resource for learning. Yeah.
When do you think a convertible notes preferential over straight equity?
So
For a business, that is.
So when would a convertible note just convert into ordinary shares?
It's better to use convertible
notes
as a means to raise capital versus using equity.
Yeah, that's a great question. I think there's a number of subtle factors. Generally, convertible notes are best where determining the value is either difficult or like you've got a key milestone that's coming up that's really going to give everybody a clear notion of what the value of the company is, but you just need a little bit of capital to get there. Maybe you're running a trial or a pilot or something like that. And rather than have a real argy-bargy discussion about this equity, like what it's worth, why don't we do a convertible note? It delays that conversation. We'll resolve which kind of world we're in, and then we'll do the equity round then. The other thing which is kind of related to that is if you're in the process of getting equity, and as I said up front, it's taking this surprisingly long amount of time, like it's at the 6 months and you've only got runway for 2 months, maybe you can just go to your current investors and say, well, why don't we do a convertible note to bridge the company through to the financing so that we get the financing done, they set the value, we don't again need to argue about what it is, and that's where a convertible note's good. I'd say they're the two best use cases of convertible notes. Convertible notes are quite often used really early stage with angels because people don't want to have that value conversation. I think that's generally a mistake because the thing with a convertible note, like the thing with equity, let's start on this side, is it really aligns interest. Everyone just wants the company to be worth as much as humanly possible because when I get more money, you get more money. So, you know, if you have the conversation, you agree, the investor puts their money in, then they should really just do everything to help you. The problem with convertible notes, particularly this early stage, is with this conversion, there's an inherent conflict of interest where the investor's going to get more equity the worse you do. So, you know, but at the same time, they want you to be successful and raise money. So, you know, it's just this kind of weird conflict where, you know, yeah, they'd prefer to get more equity, but, you know, they prefer the company to do well too. So it's often used as a avoidance mechanism where it would have been much better just to have the valuation conversation up front. Yep.
A related question. Obviously, it's trade-offs and balances between the short-term and long-term outcomes. How much should the entrepreneur and the investor be thinking about follow-on rounds and the impacts of these terms on subsequent investments?
Yeah, I think that's a really good question. And actually, that's another. Convertible notes too, you may not want to set a value. Like if you do a bridge round and set a value, then the new investor kind of looks, well, you just sold shares at 20 cents a share. I'm not paying $1. Clearly, you know, it's only worth 25 cents. So that's something where a convertible note is a great mechanism to avoid signalling to a future round. Usually with future rounds, I think you want to be aware of the terms that you're on offer, because it's quite common for future investors to want at least as good a terms as every other investor. So whatever you give up in an early right, a future investor will ask for. So I think you want to be aware of that. I think that's personally a bit overblown, because for a company that's doing well, you get to name more of the terms. So you go, well, they got, you know, preference or, you know, participation or 2x preference or whatever because they took the risk. We're now doing great. If you want in, then these are the terms. So, and I think that, you know, makes sense.
What
so
about like anti-dilution? Like if somebody, previous investors got anti-dilution rights,
yeah,
and you're coming in as the next one, does that scare you off, encourage you just out of the standard run of the mill?
Anything where a previous investor is going to get preferential treatment over a new investor, yes, that has a big impact. And it's not uncommon for a new investor to invest but then say, either we both get these rights or no one has them. And it's quite common for people to go, all right, we give them up. Because often some of these rights are really around this protection in the low case scenario. So once, you know, if an early investor bought in at 20 cents per share, the new investor's coming in at $1, the chance of that company needing anti-dilution for that new investor is quite small. Like it would take a significant reversal of fortune, you know, for the share price to be back down at 20 cents. So that's often where a new investor will come in and actually get rid of, you know, maybe participation even, or some of these other things. So that's what they'll say, either we all have it or none of us have it. And as a new investor, you know, pragmatically, you're not going to get it because the company has performed, but you don't want to be at a significant disadvantage to early, you know, you want to level the playing field a bit more. So often, yeah, those rights will be given up one by one as the company progresses. And ultimately, so therefore you get an IPO, you get to these ordinary shares because no one's got anything left. And you know, it all works out. Because it's really, certainly for most investors, what they really want to do is protect in that downside scenario. All right, we'll keep moving. So just to quickly touch on the valuation question, there's kind of two broad methodologies to do it. One is around benchmarking, which I think most people would think is the fair and reasonable way to do it, which is where, you know, multiple of revenue or EBITDA or things like that. For better, for worse, that's probably the least common way to do it, particularly in early stage ones. It's, for one thing, early stage companies will almost certainly not have EBITDA and may not have revenue. So it's really hard to benchmark at what they're actually worth. Much more common is around this exit outcomes, which is just where you say, as an investor, we have a profile return for our investments. Maybe it's 5 times. In other words, we'll go into an investment expecting a 5x return. So if we put in 2, we want to get back 10. And essentially that's risk weighting. So unfortunately not all investments work out. So, you know, half of those ones that we thought we'd get 10, we get 0. So it's more like, you know, for every 2 we get 5, and you know, that's the return that people kind of want over 5 years. So you say, all right, so there's our target return, maybe it's 5x. So if I invest $2 million and want to get 10 million back, well, what's the company going to be worth in, you know, 4 years' time? So if this is a really huge opportunity and everyone can get on the same page that actually, you know, we're going to be able to sell this business for $100 million. You know, there's a real shot at it, we've got the team, all this stuff. You get that conviction, you know. Then if the investor wants to make $10 million, they need to own 10% of the company at that point in time. So if they invest 2, then, you know, the pre-money is going to be, what's that, $18 million. So, you know, that was a valuation. Your company's worth 18 just because of, you know, what the exit outcomes kind of are. But on the flip side, if people think, well, the exit's going to be more like $20 million, then that's what the opportunity's worth, and the investor wants to get 10, they need to own 50% at the exit, and so all of a sudden your pre-money valuation is now 2 million. So you're 2 and they're 2, give them 50%. And that's probably the most common way to arrive at this pre-money valuation. One consequence of that, which is interesting and it's true, is it actually says the more money you raise, the higher your pre-money valuation will be. And that actually works out in practice because, you know, if the opportunity is big and it needs this money to get there, there's a limit at which, you know, there's no point in the investor owning 95% of the company because the entrepreneur is just not motivated. Even if by any reasonable benchmarking metric, that's what they should own, because this idea is worth 2 million, like it just is, but it needs 30 million to get going. So, you know, by any, you know, standard stuff, you go, well, they should get 90x%, you know, whatever, 90+%. But the entrepreneur wouldn't do it. You know, it's not worth their time. Well, that's not quite true, but you know, it doesn't align interests nearly as much. So you really want the entrepreneur to have a significant stake in the business. Usually, the investor wants, you know, a significant minority stake, like 30 to 40%, or probably 20 to 40% would be a range. So for a Series A investor, that's what they'd want to own. And, you know, the numbers are all going to be calculated so that they get to that. So there's enough for the entrepreneur, there's enough for future employees, there's enough for another round, things like that. So that's often how valuations get done. Finally, with the investors, like we've talked all about these terms and control and all this sort of stuff. But a hugely important factor is that investing is, you know, a bit like a marriage in a way. Like you're going to be put together with this person, you're going to work with them through thick and thin. There are going to be almost guaranteed the tough discussions, you know, when things go bad. You know, there's be great discussions when things go well. You know, and there are a certain amount of parallels, hopefully not ending in divorce, maybe that's exit, I don't know. But essentially, you know, when you get into this sort of thing, you really want to think super carefully about who you're, you know, bringing into the tent, because and there's 2 metrics or 2 factors that you'd want to think that through on. The first is just their skills and expertise. Like you are much better off getting money from someone at, you know, worse terms, who knows everything about your business and can guide you and introduce you, because a smaller piece of a big pie is better than a big piece of nothing. So you know, so that's one factor. Another key factor is, can you work with that person? And this is, you know, you can read online and stuff like that. There are plenty of nightmare stories where once the investor and the entrepreneur start to butt heads, if you can't work through the difficult conversations, the company is just not going to work. It's going to be horrible. And it'll end up badly, and usually badly means the founder gets kicked out. So, because a company will underperform, and once it starts to underperform, then all these control mechanisms start to go in the favour of the investor, and they'll begin to get more and more power, and eventually you'll need money, and the only one who'll give it to you will be that investor, and the condition will be that you go. So it can get ugly. So, and believe it or not, that is the last thing an investor wants. Because the investor wants to invest in you, they want you to do the work, they want you to build the vision, and they want you to give them this huge return. They're not in it, like for me, I've done my entrepreneurial stint, I know how tough it is, and it is tough, and you get the good outcome. I don't want to go in and run another company that I invest in, right? That's just a worst case scenario. And that's why it could be like a divorce, where there's no winners here. No one's rubbing their hands going, great, I kick out the founder, and the founder is certainly not going, great, I just lost my company. So you really want to pay attention through that due diligence and the term sheet negotiation, that if you can't have a great conversation about that, talk through those difficult issues, participation, ratchet, control, have the conversations, and you ought to be grateful in a way that these can be tough decisions where you do argue, you want this, they want that. Because see how you work through that. Because if you can't work through a term sheet, you're not going to work through, 4 or 5 years of ups and downs, or at least it's unlikely that things will go that well that you never have a fight. So, or a fight's the wrong word. You never have, the tough discussions around should you invest offshore or do a new product line. There's all these levers, and you want to have someone in your corner to work it through. So I think that's pretty much the key items I had, and I think we're well out of time. So any final questions before we wrap up? Yes, right. Oh, yeah. Yep.
Oh, sorry, yeah, just wondering what sort of background experience Starfish Ventures has with the sort of consumer internet businesses as opposed to sort of enterprise-based businesses?
Yeah, that's probably a conversation more, not for like a general topic. Whoa.
Well, just how that would affect valuation and any of the terms. Does that change anything materially that you've been through, or is it?
Yeah, well, certainly. So if I just abstract the question to say, definitely someone who understands the business better will give you better terms, because, or maybe worse, but at least that's with reason, because, and hopefully it's better because they understand it. With someone who doesn't understand the space, the risk for them, like at the end of the day, all these 5x return or 10x that they're after is risk mitigation. And if the investor doesn't, the less that they understand the space, then the more risk they're inherently taking on, and therefore the worse the terms are going to give you and the more protection, because they're just not going to see. When you go, look, it's a given that all these people, these consumers or the customers, they really want it. They're like, oh, I can only take your word for it. They don't have that inner belief. So that's where finding an investor that understands your space is fantastic. Sorry, question right at the back.
So what's your view on crowdfunding, and how is that affecting the VC market, and any examples or anything?
I think crowdfunding's really interesting. Like, at face value, I think it's fantastic because it just gives entrepreneurs a way to raise capital, another mechanism to raise capital. I think there are enormous challenges with it, because half of the things that I just went through, or maybe most of them, crowdfunding doesn't have. The crowd's not going to have the control, they're not going to sit on the board, they're not going to help you, they're not going to advise you, they're not going to make any introductions. So it's the dumbest of dumb money that you could possibly get. So from one hand, from a business perspective, yes, you get the money, and so that's good, but it may not be as good as someone who's an angel investor or someone who's just going to help you. On the flip side, the thing with crowdfunding that we haven't seen much of, that unfortunately I think is going to happen, is the scams and the companies where I said all these control mechanisms are so that people don't go off and buy a yacht. Well, with crowdfunding, that will happen some fraction of the time, and I haven't seen mechanisms that really enforce or police that. Like these crowdfunding sites, they specifically say, look, they do a little bit of DD, I think, to verify the name and address of people, but in terms of their actual character, or that the business is going to do what the business says, like, you know, they're going to raise $2 million. That founder could do anything. They could just cash it and go overseas, right? And there's absolutely no recourse. So I think it's early days. And I think there are challenges about how do you overcome that, because I think it'd be a great source of capital. I think it's good. I really support the idea of, you know, people doing it. But yeah, how to manage it is, it's pretty new and uncharted waters. And also there's 50 investors with unlisted public companies. You know, you need special rules and regulations around that. So it's going to be interesting. Like, it's early days, going to be interesting. It's certainly not, yeah, that'd be high risk capital. Like, and everyone says, like, when you crowdfund, the amount you'd invest has got to be something you're absolutely willing to rip up and throw away, because you don't have a lot of insight into that business. Like, it's just going to be tough. And this, I mean, and we'll take it back and then we'll finish up. Like, you could almost use it as an introductory format. Like AngelList, if you look at AngelList, you could think of that as crowdfunding without the back end. Like they kind of rally people together. But at the end of the day, it's up to the investors, you know, to go meet the company. And it's more like a dating site or a matchmaking service, which is fantastic. Oh, back on that marriage analogy. But, and it's good. But yeah, it really is important for both the founder and the investor to get comfortable with each other.